I am Kuldeep Singh. Welcome to our presentation on Introduction to Financial Markets and Institutions. This is session 1. Today we will cover few modules like overview of financial markets, financial instruments in details, and banking and non-banking financial institutions. The aim is to give a strong conceptual foundation illustrated with real-world examples, case studies. Feel free to note down your questions for the end of each module. Module 1. Overview of financial markets. Financial markets. These are the platform for buying and selling financial securities, commodities, and other items. Financial markets form the backbone of our country's economy. They are platforms that bring together investors with surplus funds and entities in need of capital, such as businesses and governments. Without these markets, economic activity would slow down dramatically. A financial market is more than just the stock exchange. It includes debt markets, derivatives, foreign exchange markets, commodity trading platforms, and more. It plays a very important role in economic development and wealth creation. To understand, we should imagine a financial market like a highly organized bazaar. Instead of goods like vegetable and clothes, we are trading contracts that represent value, like shares of companies or bonds issued by government or corporation. Functions of financial market. The major functions of financial market is to mobilize savings. Individuals who don't use all their income can save it. Financial markets convert those savings into productive investments. Capital formation. The process of turning savings into capital assets like factories, offices, and infrastructure. Financial markets also leads to price discovery, where markets determine the right price for securities using supply and demand. It also leads to liquidity, where asset can be bought and sold quickly. It also transfers risk, like with the help of tools like insurance, derivatives, mutual funds, which help spread risk for an investor. And they also reduce transaction cost. Intermediaries help reduce time and cost for trading. Without stock markets, companies like TCS or Infosys would, would struggle and would have not raised capital easily. And without money markets, banks would struggle to manage daily cash flows. Types of financial markets. Most common one is the capital market, where long-term securities like equity and debt are traded. For example, buying shares of Tata Steel through NSE or BSE. Equity markets is a place where shares are issued and traded. For example, where IPO of LIC in 2022. Debt market is a place which include government bonds and corporate debentures. Example, government issuing 10-year bonds to raise 10,000 crores. Second type is money market. It's a place where short-term instruments, less than 1 year or 365 days, are traded. Banks lending money overnight via the call money market is one of the examples. Derivative markets. Derivative market is the instrument where the value is derived from assets other than stock or currency. For example, hedging oil prices via future contracts. Forex markets is one of the largest in the world where over $6 trillion is traded daily. Example is RBI intervening in forex markets to stabilize Indian currency. Next is commodity markets. where we trade gold, oil, wheat, etc. Using, for example, using MCX India, we can trade gold futures. Primary versus secondary markets. Primary market is that market where the new securities are issued directly by companies or government. Whereas secondary market, for example, IPO, initial public offering, Zomato in 2021 raised 9,375 crores. Secondary market is the place where trading of existing securities among investors take place. Example is you have to a common investor has to buy Infosys shares from another investor on the platforms, different platforms. This plays very important role for liquidity as well as capital raising for the companies. Capital markets overview. It's a place where long-term debt and equity instruments are traded. It includes shares, bonds, and debentures. It plays very important role in infrastructure, industry, as well as for raising funding governments. Money market, generally short-term debt instrument less than 1 year. Examples are treasury bills, commercial papers, certificates of deposit, etc. It plays a role in liquidity management and short-term funding for banks, for corporations, as well as government. Equity. Equity market is a place where market for ownership shares is traded. Stock exchange act as an organized platform, and the price is influenced by company's performance, economic factor, interest rate changes, etc. Debt market. Market where bonds and other fixed income securities are traded. Issuers are generally governments or corporations. And instruments can vary by maturity, coupon amount, payments, risk, etc. Derivative markets. These are the financial contracts deriving value from an underlying asset. These can be of future, forward options, swaps. These are the types of derivative market. It's generally used to hedge risk or speculate or arbitrage. Foreign exchange market, currency trading markets. If an investor have to, the banks is generally trade in foreign exchange markets between INR, RD, US dollars. These are generally used to determine exchange rates. And these play a very crucial role in international trade and investment. And RBI takes care or handles all the behind the scene actions. Commodity market. This is place where physical goods trading take place like metal, agriculture, energy, and etc. They play a very important role in price discovery as well as in risk management. Market participants. Let's understand the different players. Retail investor, individual investors like all of institutional investors, mutual fund, insurance companies, pension funds. Then comes brokers and dealers, which executes trades and maintains inventories. Then come the market makers, who can be foreign investors participating in Indian markets. Then our regulators, who play a very crucial role, such as SEBI, RBI, IRDAI, etc. Intermediaries in financial markets play a very important role by facilitating transactions between buyers and sellers. It provides liquidity and helps in accessing information which otherwise would be not possible. Examples would be broker, investment banker, clearing houses, etc. Financial market instruments. Equity instruments could be the types of equity could be common shares or preference shares. Debt instruments, bonds, debentures, commercial papers, etc. Hybrid instruments, convertible debentures. Characteristics of financial instruments. Instruments are like vehicles used to invest. They vary based on maturity, which could be short or long term. Liquidity, how easily you can sell. Risk, how volatile the market or the stock or the entity is, how much is the credit risk is. Return, it could be depend upon interest, dividend, capital gain, etc. Then come liquidity, how easily can you sell, and the tax treatment. Some investments are tax free up to a limit, others are taxed. Market efficiency. Market efficiency refers to the degree to which market prices reflect all available and relevant information. It could be of different forms like weak, semi-strong, and strong. They play a very important role for investors and companies. For example, could be stock prices falling instantly after bad earnings of a company, or maybe the market-wide reaction to RBI policies announcement. The regulatory environment over. There is always a need to regulate the markets for the investor to promote transparency as well as reduce fraud. This helps to maintain market stability. Global financial markets. Some of the global exchanges include New York Stock Exchange, London Stock Exchange, and Nasdaq. It helps in cross-border capital flows. It plays a very important role in globalization of financial markets. Emerging markets. Emerging markets are generally markets which are growing, may have higher risk, but does play in global investment portfolios. Role of technology in financial markets. It helps in electronics trading platform, algo trading, real-time data and analytics, fintech innovation, and also impacts marketing. Platforms like Zerodha, Grow, Kuvera are helping a lot of investors to trade, which was earlier impossible to do from while sitting at home. Market crashes. Market crashes often arise from irrational investor behavior. For example, 2008 Lehman collapse, global contagion happened. Also, in 2020, COVID crash wiped out 50 lakh crores in 2 months. There are a lot of causes and consequences. It gave a lot of lessons for regulation as well as risk management of the market. Behavioral finance. This plays a very important role in day-to-day investing. It helps us to understand the investor psychology's impact on the markets. Common biases such as overconfidence, herd behavior, loss aversions, and they influence on market volatility. Overconfidence is generally the thing where traders make reckless bets. Herd behavior is where everybody, like for example, everybody is buying. There was a time when everybody was buying crypto blindly. So, as an investor, understanding these biases helps us avoid mistakes. There have been new trends that have been coming in the financial market. For example, increasing automation, rise of environmental sustainable goals in investing, which have led to discovery of new types of financial instruments that we will see from them. But and also shift towards digital assets. Now, we would be seeing types of financial instruments. A financial instrument is an asset that retains capital and may be traded on the market. Financial instruments are contracts that represent financial value. They allow individuals, companies, governments to raise funds, invest, hedge risks, as well as manage wealth. In this module, we will break down equity instrument, debt instrument, derivatives, hybrid instruments, mutual fund, ETFs, and other modern innovations. We will also explore how these instruments differ in risk, return, taxation, and regulation. Equity instruments overview. They generally represent ownership in a company. These can be the of types, so can be common shares or preference shares. It helps in risk. They play a role for the rights and risks of shareholders. For example, buying 100 shares of Infosys give you a slice of its future profits. Common share. They give you voting rights, dividend entitlement, capital appreciation, but it also has risk in the form of market volatility or company's performance also affect these. Another type is preference shares. Preference share generally gives you preference in dividend as well as in liquidation. Whenever a company is getting liquidated, preference shares holder generally are liquidated first, or they are in the top part of the preference list. For example, company issues 10% preference shares. Investors get nearly rupees 10 yearly per 100 share, regardless of profit, whether the company makes profit or does not make profit. Equity shareholders are generally risk takers and may lose value during downturns, but they generally also benefit during booms. Debt instruments overview. These are the instruments which involve borrowing with the promise to repay, which could be fixed or variable. It's generally issued by government, corporations, or financial institutions. The next, one of the type of debt market is bonds, which are generally raised by companies, government, municipal corporations, etc. They are issued on a particular face value at a particular coupon rate with the maturity date. They give you fixed yield, fixed return over the time. For example, RBI issues 10-year bonds at 7%. So investor earned 70 rupees yearly per 1,000 rupees invested. Next is the debenture. Debentures similar to bonds but often unsecured. They generally have higher risk as well as higher yield compared to bonds. They are typically issued by corporations. Commercial papers. These commercial papers are issued by corporations for short term, 90 to 364 days, generally used for working capital financing and issued by generally top rated company. These are short term, unsecured, but promissory notes are issued. Next comes certificates of deposits. These are the time deposits issued by banks for short duration. They generally have fixed maturity as well as the fixed interest rate, which is fixed at the time of auction. They are also tradable in secondary markets. Treasury bills. These are short-term government securities which are issued at discount but mature at face value. These are considered one of the safest market instruments as government itself borrows through this instrument. These can be of different tenures, 91 days, 182 days, and 364 days. It's generally issued by RBI on behalf of the government. For example, a 91-day T-bill, treasury bill, worth 100 rupees may be issued at rupees 98. The 2 rupee gain is the interest that the investors benefit. Hybrid instrument. Generally, convertible debenture is the most commonly used example of hybrid instrument. These are preference shares with warrant, and these combine the features of debt as well as equity. Derivatives. Derivatives derive their value from an underlying asset and is a financial contract between two parties. It could be currency, it could be stock, it could be a commodity, and it is generally used for hedging or speculation or arbitrage. Future contracts. One of the most commonly used derivatives is future contract, in which an agreement to buy or sell asset at a future date or price is done between two parties. These are standardized contracts traded on exchanges. For example, a farmer hedging against a fall in wheat prices. Options. Options is where you have a right but not obligation to buy or sell an asset. Call and put options are generally used in option contract. For example, buying a call option on Reliance gives right to buy at 2,500 even if market price goes to 2,800. Swaps. These are the contracts with exchange cash flows. Common type are interest rate swaps, where two parties could be banks, could be corporations, generally go into a contract where they would fix a interest rate even if after some time the interest rate is changed by RBI, the rate would remain same for the corporation to pay the bank. Used for risk management. Also, airline hedges oil prices using futures. Importers hedge currency using options. Mutual funds and mutual funds are pooled investment vehicles which are managed by asset management companies. These are represented in the form of units, which represents ownership in the fund depending upon the amount that the investor has invested. The advantages are diversification for the investors. It also adds by minimizing risk as they are professionally managed. For example, SBI in SIP in Axis Blue Chip Fund, investing 1,000 rupees monthly into top large cap companies. ETFs, exchange traded funds. These are the instruments which are just traded like shares, but passively track indexes. These are generally present in the much lower cost than actively managed mutual funds. For example, Nifty 50 ETF by Nippon India. They help in diversification, liquidity, and small ticket sizing. What are the characteristics affecting instrument choices? There are mainly four characteristics which affect instrument choices. Number one is risk tolerance, return expectations, investment horizon, and liquidity needs. For example, for equity instruments, the risk is generally high, but the return is also high. which also leads to the liquidity, high liquidity. For examples of equity shares. Now come debt. In the debt market, the risk is generally low to medium, but they all have a fixed return, which also leads to medium to high liquidity. Most commonly used debt are bonds. Next come derivatives. The risk derivatives are very high, but they also have a variable return. Derivative market also have a high liquidity. Next, as a mutual funds. Mutual funds, the risk varies depending upon the scheme or the plan that the investor has invested in. The return is market linked and the liquidity is high. Then there are hybrid instruments as well, which have a medium risk, moderate return, as well as medium liquidity. The examples of hybrid instruments are convertible debentures. Risk and return trade-off. Generally, higher returns generally means higher risk. Equity offers highest potential return but highest risk. That offers security and predictability of returns, which means that greater the risk, greater the return. We should generally diversify to manage risk. For example, a portfolio of 50% equity, 30% debt, and 20% gold balances risk and return. So the role of financial instruments in portfolio construction is very important. Pricing of financial instruments. These factors are could be there are multiple factors that influence price, such as interest rate, credit risk, market demand, time value of money concept that affect these pricing. And other factors which could also affect the pricing are expected cash flows, credit quality, market demand, credit ratings. Credit rating agencies assess the default risk of the instrument. Companies, corporations. There are multiple agencies like CRISIL, ICRA, Moody's, S&P. They help in assessing the creditworthiness of the investment. They generally give different ratings based on their creditworthiness. AAA generally said to be the best, and D is generally for default, but anything below triple B is considered junk. It plays an impact on interest rate and investor confidence. Generally, higher rating means lower borrowing cost. For example, IL and FS downgraded triggered bond market crisis in 2018. Tax implications of instruments. Depending upon the financial instrument that an investor has invested in, there are different tax implications. For example, dividend tax, capital gains tax, among others. There are tax advantages in certain instruments which an investor can use. For example, equity long-term capital gain is generally taxed at 10% beyond 1 lakh. Debt funds are taxed after 3 years at 20%. TDS may apply to interest income earned by an investor. These are very important for an investor's net return. Regulatory aspects of instrument. Generally, most of the financial markets are regulated by SEBI, Securities and Exchange Board of India. There are few requirements disclosed to, and these are generally given to protect investors from the fraud, marketability, and liquidity. Under this, how easily can instruments be bought and sold is generally determined. Impact on pricing and investor preference is generally decided. For example, real estate is considered illiquid, whereas stock market is generally a very liquid place where you can get your money out within minutes. Whereas
Uh,
can you please mute your mic? Samruddha, can you please mute your mic? Role of instruments in economic growth. Financial instruments generally play a very important role by channeling savings to productive uses. It could be to earn more money, or could be to grow, to derive growth from by investing in infrastructure or industrial projects. Enable corporate expansions as well as government funding, which in turn support employment and infrastructure. Financial instruments allocate capital efficiently. Bonds finances generally infrastructures, shares fuel business expansion, and mutual funds deepen capital markets. What are there are some many recent innovations in financial instruments. For example, green bonds. They are generally environment linked to environment. Social impact bonds, crypto ETFs, digital gold, and fixed income platforms, digital assets, among others. Now, I would like anybody has any doubt to please note down in the chat box so that we can take it in between. Okay, I think I can find. Now we would seeing the module 3, where would we seeing banking and non-banking financial institutions. Financial institutions are generally organizations that provide financial services to individuals and businesses. They generally act as intermediaries to channel funds between savers and borrowers. They facilitate the flow of money in the economy by providing essential services like loans, insurance, retirement planning, etc. And they also promote financial inclusion. What are the types of financial institutions? Generally, banking institutions could be of two types, commercial or cooperative. And there are non-banking financial institutions like insurance companies, pension funds, NBFCs, mutual funds, etc. What are the role of banks in the economy? One of the most commonly known role is to accept deposits, which helps in mobilizing savings and offering credit. Banks also provide loans, also facilitate payments and settlements, act as monetary transmission agents. They enable digital payments as well, maintained financial stability, and maintained liquidity in the economy. For example, SBI provides education loans to students under different government schemes. Types of banks in India. Scheduled commercial bank. These can be of many types like public sector banks, which are generally owned by Government of India, or for example, SBI State Bank of India is one such example. Another would be private sector bank, which are privately owned, could be HDFC Bank, Kotak Mahindra Bank. Then comes foreign banks, which operate branches in India, like HSBC, and there are regional rural banks which serve rural India. Then comes cooperative banks. Cooperative banks are generally made up for a particular purpose by cooperating different people together to serve a purpose. And another type is payments and small finance bank. These generally are for underserved segments which handle small savings. Public versus private sector bank. Public banks are owned by government, whereas private banks are owned by private entities. The major difference is there in the management style, the efficiency level, and the service levels as well. RBI, Reserve Bank of India, is the central bank of India which regulates banking sector. It controls money supply as well as inflation, and it also acts as lender of last resort for all banks, which we seen in the example of Yes Bank crisis. RBI also issues currency and also it manages foreign reserves for India. Functions of RBI. It regulates and frames monetary policy. It manages forex and public debt, regulation of banking and non-banking corporations, and it helps in promoting financial inclusion. Commercial bank. Commercial bank. What are the key functions of it? They generally accept deposit and offer broad aspect of services. They provide loans and advances. They help in credit creation. They invest in securities. They also offer locker services, remittances, and different types of card services as well. Non-banking companies. These institutions are not classified as banks because they cannot accept deposits, and they are generally only focused on lending or leasing. It provides loan, investment, microfinance. These are also regulated by RBI, just like banking corporations, under different guidelines. Examples could be Bajaj Finance, LIC, Housing Finance, etc. Types of NBFCs could be like asset finance companies, investment companies, loan companies, infrastructure finance companies. They generally powers our infrastructure like roads, bridges, microfinance companies which offers microfinance to people demanding very small amount of money for day-to-day life or setting up small businesses. And then comes housing finance companies, insurance companies. Insurance companies provide risk protection in return for premium. Insurance is generally of two types, life as well as general. The biggest company in life is LIC, Life Insurance Corporation. And for general insurance, we can say the example is New India. These are regulated by IRDAI, and these are very critical for financial protection and intermediation. IRDAI, this is the insurance regulator in India. IRDAI stands for Insurance Regulatory and Development Authority of India. It licenses insurance and intermediaries. It ensures fair pricing, solvency, as well as transparency. It promotes awareness and penetration in the market. Next come pension funds. Pool requirement savings. Pension funds generally pool retirement savings and invest for return. These are generally managed by pension fund manager. Major schemes include NPS, EPFO, and these are pension funds are regulated by PFRDA. Pension funds supports long-term capital formation. Mutual funds. Mutual fund is a place where the money is collected from investors in small amounts, be it could be one time or monthly payments, and which is generally invest in diversified securities. These are managed by asset management companies, AMCs. They offer liquidity, diversification, and one of the most important benefit of investing in mutual fund is professional management. They are also managed by JB, just like any other financial market instrument. For example, SBI small cap, HDFC top 100. These are some of the examples of mutual fund. Mutual funds can be of various types. Could be based on structure, could be open-ended or close-ended. It could be based on different asset classes. It could invest in equity, debt, hybrid, liquid funds, large cap, small cap, among others. There are also sectoral funds, depending on sectorals. Could be infrastructure, could be banks in particular, and other types of which only focuses on one particular sector. Credit rating agencies. It assesses creditworthiness of borrowers and instruments like CRISIL, ICRA, CARE, India Ratings. These instrument markets, lending, as well as risk perception. Ratings impact interest rate and investors' trust as well. Cooperative banks. These are the banks which member owned these institutions, generally operate in rural or semi-urban areas. Cooperative banks generally provide agriculture and small business credit. These are generally regulated by RBI as well as state cooperative registrars. Regional rural banks. These are government-sponsored banks focused on rural development. These are generally owned by central government, state government, and are also formed in partnership or in part with by sponsor bank, which could be a cooperative bank, public sector bank, or a private sector. Its aim is to promote financial inclusion in rural India. Small finance bank. These small finance banks generally provide basic banking services to underserved segments. They generally target MSMEs, medium, small and medium enterprises, small farmers, and also unorganized sectors. Just like everything else, they are also licensed by RBI and must follow priority sector norms, which other banks like public or private sector banks also following, buying by lending 40% of its total capital to priority sectors mentioned by RBI in its rules. Payment banks. This is a new trend you can say has been seen in the past few years, which they generally accept deposits in small amounts to 2 lakh. They cannot lend or issue credit cards. They are generally focused on mobile and tech-based banking. Example could be Paytm Payments Bank, India Post Payments Bank, development financial institutions. Development financial institutions generally provide long-term financing for industrial and infrastructure development. Example are NABARD, SIDBI, NHB, etc. These generally support sectors which are not served by commercial banks because the profit margins are generally very low or the time to break even are very long periods. Role of technology in banking. The mobile banking apps like UPI, NEFT, IMPS play a very important role nowadays. Everybody of us uses it. AI chatbots in helping customers, AI in credit scoring. AI also plays very important role in fraud detection. Recently, rise of digital first neobanks have also taken place. And most importantly, technology is the backbone of core banking systems nowadays. Any bank, be it cooperative, scheduled, any type of bank, cannot operate without technology in core banking systems. Financial inclusion in India. Multiple steps has been taken by Government of India to improve financial inclusion for the underserved. Key schemes like PMJDY, PM Jan Dhan Yojana, where free bank accounts were opened, direct DBT, direct benefit transfer subsidy directly to the beneficiary, and PMMY, where loans were given to small businesses. Now we will be seeing what are the financial instruments. What are financial instruments? These are the contracts representing financial value. These can be traded or exchanged, and they also serve as a store of value, medium of exchange, or investment vehicles. What are the classifications of financial instrument that we have seen? Debt instruments, we generally have bond, debentures, etc. Equity, shares, common or preferred. Derivatives, future, forward, option, swaps, as and hybrid instruments, which are convertible bonds, preferred shares, etc. Money market instruments, treasury bill, government issues short-term bills, 91 days, 182 days, or 364 days. Then comes commercial paper, which are corporate unsecured debt, certificate of deposit, which are issued by banks to raise money. And another type is when says call money, which is generally used by banks for overnight lending and generally happens between interbank at a fixed rate. Capital marketing, equities, shares, which generally helps you getting an ownership stake in a company, preference share where you get a fixed dividend, and you also get priority over common shares, bonds, fixed income debt instruments. We generally get a fixed instrument depending upon the coupon rate and the face value of the security. Debentures. These are generally unsecured debt instruments. Equity. Equity represents ownership in a company. You also get voting rights on corporate matters. You, if the company is profit making and want to share profits with its investors, it generally gives dividends. And the residual claim on asset during liquidation is also given to equity shareholders. Type of equity shares. One of most commonly used are common shares or ordinary shares, preferred shares with dividend preference, bonus shares, where the shares are given for free to existing holders, and rights shares, rights issue, which are issued to existing shares holders as well. Preference share key points. Under preference shares, investors generally get a fixed dividend rate, which the company has to distribute to them, even if they are not making a profit. They get priority in dividend and capital repayment. It can be cumulative or non-cumulative. Sometimes company also offers investors to convert their preferred shares into normal ordinary equity shares. But that happens very rare. Bonds. Overview. Debt instruments issued by company. Return principal. The principal is returned at maturity and you only get fixed interest rate. That is also known as coupon. And they are just like equity markets traded on bond markets as well. Very liquid, but has gives a fixed interest rate. That's the best benefit. There are multiple types of it, such like government bonds issued by governments. Similarly, corporate bonds issued by companies, different corporations. Another type, one most commonly type is zero coupon bond, where you don't no periodic interest. You just get the amount at the end of the period. And convertible bonds. Convertible bonds are bonds which can be converted into equity after a certain period of time by the company. Commercial papers. These are short-term, unsecured promissory notes issued by corporations for raising working capital, usually as low as for 7 days or maximum is 1 year. They are generally issued at discount and redeemed at face value. Derivative instruments. These are financial contracts derived from underlying assets.
તમને નથી થતા કે એમાં એક ફાટી ગયો કયું નથી થતું એક ફાટેલું છે એનું હાફ પેન્ટ થઈ શકે તો એકનું હાફ પેન્ટ કરાવશે અને બીજું અગર તમને થતું હોય તો રાખો ન થતું હોય તો ઠીક છે લઈ લો અને તને થઈ રહે કે
Viren, can you please mute
કમર
your mic?
વધારે છે બાકી બધું બરાબર છે વધારે તો કદાચ એક મને હા તો એ જોઈ લો ને જે ફાટેલું હોય છે એનું હાફ પેન્ટ થતું હોય તો એનું હાફ પેન્ટ કરાવી નાખો
Viren, can you please mute yourself? Derivative instruments. These are the financial contract derived from underlying assets. The purpose is hedging, speculating, or arbitrage. Future is an type of contract where an agreement is done between two parties to buy or sell at a predetermined price on the date. And these are standardized contracts and which are traded on exchanges. It's generally used to hedge price risk. Options is a right but not obligation by the party to buy or sell asset. Buy generally is referred as call and sell is generally referred as put. But there is a premium that is paid upfront and options contract also provides flexibility with limited risk. Swaps. Swaps is a type of instrument where the agreement is exchanged between two parties to exchange cash flows. Could be type the common types of swaps are interest rate swaps where the two parties generally decide what interest rate they would be paying. That could be fixed rate, that could be floating rate, depending upon the contract or the agreement that the two parties get into. Similarly, it can be of currency swaps as well. They fix a particular rate to exchange currency, irrespective of the change in the currency in the future time. Swaps are used for managing interest or currency exposure. Hybrid instruments. Hybrid instruments combine features of debt as well as equity. Examples are convertible bonds, preference shares with convertibility. They offer flexible financing options. Depository receipts. These are the instruments which represent shares in foreign companies. There are also, if a person is sitting in India is investing in American companies, in Indian companies listed in America, they have to buy through American depository receipt. Similarly, for everywhere else other than America is called global depository receipt. These helps to enable cross-border investments and to raise money and bring it back for further expansion of the business. Securitization. It's generally securitization is where the pooling of assets is created to create marketable security. It's generally common in loans or mortgages, which provides liquidity to lenders. Mutual fund units. Units represent ownership in mutual fund portfolios. It could be open-ended or close-ended. And these mutual fund units are generally valued at net asset value. Traded like stocks on exchange, ETFs, similar to generally stock but have minor differences. These are generally low cost and are very flexible investment vehicles. In ETF, we track indices, commodities, or basket of assets. Money market mutual, in which we invest in money market instruments, which provide safety, liquidity, and modest returns. These are generally suitable for short-term parking of funds. Financial instruments and the risk associated. Different instruments carry different profiles, risk profile. Equity generally have high risk but high return. Debt is generally lower risk but have a fixed return. Derivatives, potential for large gains as well as for large losses. Pricing of financial instrument. The pricing of financial instrument is decided based on the present value of expected cash flows. These are generally influenced by interest rate, credit risk, or market movement. Yield curves and discount rate plays very important role in the pricing of financial instrument. Credit rating and instrument quality. Ratings by agencies impact cost and marketability. AAA rating is generally given to the highest safety instrument. Junk bonds or the bonds with low rating generally lower than triple B are called junk bonds, which are very, very high risk, but also give high yield. Investors generally use credit ratings to assess the risk of the instrument. Regulatory aspects of financial instruments. SEBI oversees securities as well as derivatives. RBI regulates money market instruments. IRDAI are generally for insurance linked products. So they are very clear guidelines for maintaining, regulating securities by SBI. Similarly, RBI regulates money market instruments, which are short term, and also take care of monetary and economic policies and forest reserves, among others. IRDI have their as they completely fixed limits for insurance linked products as well. Then in compliance and investor protection are the common aspect among all of these agencies that they play, the role that they play. Role of financial instruments in capital formation. Financial instruments play a very important role in capital formation by facilitating efficient allocation of resources. These enable risk sharing among investors. They provide liquidity as well as investment opportunities for investors, which in turn help support economic growth of the country. Innovations, structured products, green bonds, and social impact bonds, digital assets, and cryptocurrencies are the new innovation that has been taking place for the past few years, and tokenization of assets to store it easily and which helps also to access it anywhere that we want at any point of time. Risk associated with financial instruments. There is market risk, there is credit risk, as well as liquidity risk. Also, operational as well and legal risk also plays very important role, which gave a very big importance to risk management tools, which can be used by investors to assess the risk depending upon the instrument that they are investing. Financial instruments and portfolio management. Diversification benefits helps in portfolio management of an investor by minimizing the risk. He can divide equity, debt, and hybrid instruments depending upon his risk appetite. Asset allocation strategies also play a very big role, and matching instruments to risk appetite as goal as an investor should be the utmost priority for any investor. Global financial instruments. Euro bonds, foreign currency bonds are some of the global instruments that are used. And nowadays, it has been very easy to access international equity markets through different platforms. And also nowadays, cross-border derivatives can be bought and sold by Indian investors across the world and vice versa. Now we would be seeing some financial institutions and regulatory frameworks. Finance overview of financial regulation. The purpose is to maintain market integrity for investors by ensuring financial stability. Frameworks include laws, rules, and regulatory bodies. Financial regulations helps in balancing innovation and also controlling risk. Key regulatory bodies in India. Reserve Bank of India, the SEBI, Securities and Exchange Board of India. Then comes IRDAI, Insurance Regulatory and Development Authority of India. PFRDA, Pension Fund Regulatory and Development Authority. And at the Ministry of Finance and Department of Financial Services also keep an eye on different aspects of regulation. Role of Reserve Bank of India. Reserve Banks of India generally regulates banks and NBFCs. RBI, Reserve Bank of India, also issues currency as well as manages liquidity. Reserve Bank of India implements monetary policy as well, and one of the most important role that RBI plays is acting as a lender of last resort for any financial entity, be it commercial bank, cooperative bank, to safeguard the deposits of the depositors. SEBI, Securities and Exchange Board of India. It regulates market, stock exchanges, brokers, everything. It protects investors from malpractices by keeping an eye on all type of financial instruments and the entities that take part in it. It encourages market development and transparency between investors, companies, brokers, dealers, and other intermediaries. Functions of SEBI. SEBI most important function is it is used for registration and regulation of market intermediaries. It regulates public offering and disclosure. For any public a company that wants to get listed for the in the primary market, for example, initial public offering has to get itself cleared by the SEBI. It also enforces insider trading laws and market manipulation control. SEBI also runs a lot of investor education programs. Like mutual fund sahihai.com has been a great success nowadays. IRDAI, Insurance Regulatory and Development Authority of India. It regulates insurance companies and intermediaries. It ensures solvency and also ensures fair pricing of the product that is sold by the company. It protects policyholders' interest and makes sure that the insurance penetration reaches unserved regions and also helps in promoting innovation in the insurance sector. PFRDA, Pension Fund Regulatory and Development Authority. PFRDA regulates pension funds and schemes. It leads to transparency and also helps in protection of subscribers' interest. As the pension is considered one of the most important aspects for any individual, salaried individual especially. It manages NPS, National Pension System, one of the most important schemes run by PFRDA. It promotes pension awareness among job people, and also it provides financial security for retirees so they can live a life peacefully. Ministry of Finance policy framework. Ministry of Finance and the multiple department under it formulates financial sector policies as well as reforms. It coordinates with regulators for implementation. It oversees public sector financial institution and reforms. Financial Stability and Development Council, FSDC. It is the apex body for financial stability and inter-regulatory coordination. It is chaired by the Honorable Finance Minister of India, and the members include RBI, SEBI, PFRDA, IRDAR, their heads. It monitors systematic risk and policy coherence. Few financial sector laws, important financial sector laws that The most important is the Banking Regulation Act, launched in framed in 1949. Then the Securities Contract Regulation Act, 1956. SEBI Act, Securities and Board Exchange Board of India Act, was framed in 1992, passed by our Parliament. Insurance Act was first passed in 1938 under the Britishers, but it was reframed as IRDAI Act in 1999, and the most recent among them is PFRDA Act in 2013. Know your customer and anti-money laundering. KYC norms to verify identity have been set up across any financial instrument that an investor invests in. Anti-money laundering is used to prevent illegal money flows that could be used to finance terrorism or any illegal activity. It is mandatory for banks, NBFCs, mutual fund, and insurance to do KYC, know your customers, for all new investors or the participants in their schemes, and also renew KYC at a particular interval. Investor protection mechanism. Multiple mechanisms have been developed, such as redressal forums by SEBI scores, banking ombudsman, where you can just mail banking anonymously, the, anything, any grievance that you have, and it would be kept private and solved. Investor education and awareness programs are run to safeguard investors. Strict disclosure and transparency norms are taken care of, and penalties for fraud and malpractices by companies are decided to protect investors from any losses in any type of financial instrument. Corporate governance in financial institution. In any financial institution, the role of board as well as their management is very important. Transparency and accountability of the board or management make sure that whether it the company is would be serving their customer rightly with ethics, or is that, or would they be cheating their customers. Corporate governance helps in prevention of conflict of interest. Corporate governance also helps in regulatory compliance and risk management to protect investors in the long term. Basel norms. Basel norms were framed in Basel, Switzerland, to safeguard invest depositors across the globe. There have been multiple Basel norms, Basel 1, Basel 2, Basel 3, which have been adopted by RBI. They provide a rate at which the bank should maintain the depositor's money in cash for any difficult period of time. Basel norms are international banking standards for capital adequacy. These are used to manage risk, and they have a certain amount of CAGR, capital adequacy rate, CAR rate, to maintain depositors' money. It enhances bank resilience during bad times and protect depositors' money. Priority sector lending. Banks mandated to lend to agriculture, MSMEs, and weaker sections. Generally, the rate is at 40% for most of the banks, which they have to provide to agriculture, MSMEs, or weaker sections. Generally it is decided to promote inclusive growth of all sectors, sections of society, not just one particular society, section of society should have growth in their life, but agriculture, people associated with agriculture, and that is the sector where most number of peoples are employed in directly or indirectly. And it is monitored by RBI itself and supervised by the government of India. Non-performing assets, loans which have been overdue for over 3 months, 90 plus days, are generally classified as NPS. NPS impact usually on banks' profitability as well as credit availability for newer loans. There are regulatory norms for provisioning and resolution, IBC norms. Insolvency and Bankruptcy Code, IBC 2016. This was passed by the Parliament for the resolution of stressed assets. This gives a time-bound process for insolvency resolution for the banks to promote creditor rights and healthy credit culture. What are the role of credit rating agencies? It assesses credit worthiness of issuers and instruments. It influences interest rate and investor confidence. And they are directly regulated by the Reserve Bank of India. Financial literacy and inclusion. Financial literacy plays a very important role. So does financial inclusion. Importance of educating public on financial products and risk has been at the forefront, upmost priority for the government. Government have also successfully ran schemes like PM Jan Dhan Yojana, Jan Dhan accounts, Mudra Yojana to improve financial literacy and increase the financial inclusion in our country as much as possible. Role of NGOs and financial institutions were also greatly applauded by the government of India in increasing financial literacy and inclusion. Emerging regulatory challenges, fintech innovation and digital currencies have been the newer trend in today's financial market, but they have been very difficult to regulate. Cyber security and data privacy pose a big threat to today to investors for the loss of their private data through which they can lose their hard-earned money. Regulations of cryptocurrencies and blockchains have been nearly impossible or very difficult by the regulatory bodies across the globe because of their dark nature. You generally don't know from where the money is coming and where it is going, who holds the currency, how much, and what is the purpose that they are using for. It balances innovation with consumer protection. Impact of global financial regulations. There are multiple global bodies like BIS, Banking Standards, which in IOSCO, International Monetary Fund, World Bank, which influence financial regulations globally. These are generally there for cross-border regulatory corporations to stop money that could be used for drugs or terrorism or any illegal activity. Global financial regulations uh, lead to impact of international standards of Indian markets as well. Self-regulatory organizations. Industry-led bodies with regulatory powers. For example, BSE, NSE, AMFI. These bodies, though they are generally companies, but they themselves have regulatory powers to protect investors' money. For example, BSE itself, through their in-house investigation, can lead to blocking of trading of any entity that is found to be doing a wrongdoing. They generally complement government regulators in enforcement of laws and protecting investors' money. The role of financial ombudsman. Ombudsman generally provide fast, cost-effective dispute resolution for consumers. They cover all sectors, banking, non-banking, insurance, mutual fund, etc. And financial ombudsman generally enhances consumers' confidence in the system, be it financial instrument, be it insurance, be it investments, be it pension funds, for early settlements of the disputes between multiple parties. Then a very important aspect is ethics and compliance in financial institutions. Ethical standards should be there for every professional as well as the institutions because professionals make the institution. There should be anti-corruption, fair dealing, and confidentiality of for protecting important informations of investors. There are generally compliance programs which they run, financial institutions runs. Financial institutions often also have internal audits to find out any wrongdoing in the company itself. And corporate social responsibility in finance. It has a mandated CSR spending for certain companies that is could be
है क्या क्या बोल रही है कोई शर्ट है ना शर्ट सब तो सूख ही गया हुआ है
financial institutions promote sustainable development. They generally spend a part of their profit to promote sustainable development through their be it by setting up schools, hospitals, etc. They are generally impact very they have a big impact on social and environmental goals. And generally through CSR, companies act through hand in hand with the government to increase or to improve be it the education system, hospital network, or the awareness that it wants to arrive. Financial market instruments. Financial market generally have a lot of institutions which are generally not talked about, like clearing corporations, depositories, and payment systems. They help in ensuring safe and efficient settlement of transactions. But they are also regulated by RBI and SEBI so that they themselves don't do any wrongdoing or promote any wrong work. Digital payment regulation. Due to the recent rise in digital payment using such as UPI, internet payment, NEFT, there have been recent guidelines for UPI wallets, prepaid payment instruments. Security standards have been raised to protect consumer as much as they can. And also by having regulations for digital payments, it promotes cashless economy by increasing the confidence of the people in the system. Anti-fraud measures in financial markets. Surveillance and monitoring by exchanges and regulators is done at 24/7 into 365 to catch any fraud in the financial system anywhere, be it by companies, be it by brokers, dealers, anywhere. They also regulate insider trading. They make sure that no company, investors, brokers are found to be doing insider trading, which leads to loss to other investors. Financial markets and institutions also have whistleblower policy through which anybody can make a complaint anonymously with the plea so that the fraud can be prevented or the fraudsters can be caught easily. Future of financial regulation. Data analytics and AI in a regulatory compliance like RegTech play a very important role for financial regulation. Open banking and API frameworks have also increased the aspect and the regulating powers of financial systems. Also, by increasing the focus on sustainability and ESG factors, environmental sustainable goals, has increased is the future of financial regulation. So now we would be seeing financial markets operation and technology. In financial market operation, execution is a very important aspect. So is clearing and also settlement of trade between two parties or investors. Smooth operations of financial market in financial market is very much required for market efficiency. Roles of brokers, dealers, exchanges, clearing houses is very important in financial market operations because they make sure the system is working efficiently and correctly all the time behind the scene. How is trade executed? The first and the most important step is by order placement by an investor, which leads to order routing to exchange or OTC market, over the counter market. Matching of orders is done on the exchange platforms. Then the trade confirmation is received and reporting is done. Clearing of trades. Process of validating and recording transactions. In trading, with making sure that the trade are validated as well as recorded is at most important. It ensures both parties meet obligations and it is managed by clearing corporations like CCI, Clearing Corporation of India. Settlement mechanism in financial market. It generally uses delivery versus payment system. There are a lot of settlement cycle, but in the equity markets, the most commonly uses T+2. It could be used in physical settlement methods, or it nowadays very common is electronic settlement methods for settlement of trades between two parties. What are the role of depositories? Depositories, one of the most important role it has is to hold securities in electronic form, which is also known as dematerialization. Depositories also help in facilitating transfer and pledge of securities. Depositories also provide account statements to investors so they can keep an account of their multiple investments that they have made. Dematerialization of securities. Dematerialization of securities generally means conversion of physical certificate into electronic form. The most common benefit is to reduce is commonly done to reduce fraud, enhance speed between multiple trades, and to increase the convenience for the investors. Nowadays, it is mandated for all listed securities in India to do dematerialization of the security, custodians and their functions. Custodians hold securities on behalf of individual investors. It is generally used for safekeeping, settlement support, and corporate action processing of the securities. And it is most commonly used by foreign portfolio FPI, foreign portfolio investors, or FII, foreign institutional investors, and it plays a very important role in their holding of the security. Stock exchanges. Some of the key players in stock exchanges are NSE, National Stock Exchange, BSE, Bombay Stock Exchange, and there are multiple regional stock exchanges. And the function of all these is to provide liquidity, price discovery, and transparency of the information among the investors. Over the counter markets, one of the most common markets generally used for contracts is these over the counter market, where decentralized market for unlisted securities. These are generally done by two parties sitting across the table. For example, derivatives, debt instruments trading, and it though as it is not listed on the exchange, it generally leaves has very less transparency and very high party risk. To avoid the risk of OTC markets, we use electronic trading platforms, which has automated order matching systems, which reduces the risk of frauds and increases the speed, and also leads to reduction of transaction costs largely. Algorithm trading and high frequency trading also uses these electronic trading platforms to complete the trade in no time and reduce the transaction cost. The role of brokers and dealers. Intermediaries between buyers and sellers. Brokers generally act as intermediaries between buyers and sellers, whereas dealers generally trade on their own account on behalf of someone. There are multiple regulatory requirements to become broker or dealer. Also, you generally need licenses and clearances from the different bodies to become broker or a dealer. Clearing corporations. Clearing corporations act as central counterparty to reduce counterparty risk. It makes sure that the securities from one person is transferred to the another. It manages margin requirements and risk as well. It also ensures financial integrity of the market, so that the common investors can take part in the financial market. Settlement risk and mitigation. Types of settlement. There are multiple types of settlement risk. For example, liquidity. If an investor does not have enough liquidity in his account, that's one of the very big risks. He might not be able to buy the security or sell in. Then comes the principal risk. A person might want to buy but in a for particular amount, but he does not have the principal to buy the security. Generally, margining is used, netting is used, or something as collateral is kept to improve the settlement. and to mitigate it so that the two parties can continue with their settlement even if they don't have their enough principal or liquidity of funds. Delivery versus payment system, it reduces risk and improves the mitigation. Financial market infrastructure regulation. There are multiple regulatory guidelines for clearing houses as well as depositories in the financial market to improve the time for clearing as well as making sure the transfer of securities take place efficiently in no time. There are multiple operational risk management and disaster recovery tools that are used to make sure the transfer, be it of security, be it of fund, and the execution takes place at ease. There are also cyber security protocols so that the private and important information like bank account and other things does not leak of any investors to which can lead to harm of the investor. The role of technology in financial marketing. Technology plays a very important role in financial market, in trading, in clearing, in settlement, or be it in compliance. The technology is used for real-time data dissemination, which enhances transparency as well as improves efficiency for the settlement of trade between the two parties. Algorithm and high frequency trading. Automated trading is generally used using pre-programmed strategies. Coders using a particular platform or a coding language make a particular set of pre-programmed strategies and store it, which computer themselves uses those strategies to trade, and the investor or the trader does not have to change, come in between to change the investor techniques. They will make sure that the strategies are implemented without any fault. It impacts on liquidity. Generally, high frequency trading takes place with big amount of capital, requires big amount of capital, which impacts liquidity as well as volatility. Due to high frequency trading, there are lots of Nandini, can you please mute your mic?
हिने नाही गेला तुम्ही यायचं होतं लगेच बोललो नाही पैसे तर लगेच निघाले तू ये मी येणार आहे नाही एकदा बोललो आजपर्यंत कधी नाही
Nandini, can you please
बोलल्यावर
mute your mic?
बरं यार तू तुला काम असेल समोरच्याला कसं आहे
Next. High frequency trading also has a lot of regulatory concerns and it need to be taken care of. Blockchain, a new phenomena, but it has also led to the completely disruption in the industry. Use of blockchain is used mainly for settlement or clearing. Benefits of using blockchain is that it increases transparency. It reduces intermediaries and directly transfers fund or securities from one investor to another, even without the need of multiple brokers or dealers in between. Distributed ledger technology is a pilot project recently launched and has a lot of future potential in the financial ecosystem. Digital wallet and mobile payment. A new wave in the digital wallet has taken place while a lot of companies have invested in this part, which has led to growth of mobile-based payment platforms, which has led to integration with financial markets for ease of investment. Security features and regulatory oversight is one of the biggest concern in digital payment or mobile payment companies. Loss of data has been reported on multiple instances by these mobile payments companies, and it should be need to be taken care of. Fintech innovation, robo-advising, peer-to-peer lending, and crowdfunding are some of the recent innovations in the fintech world. Robo-advisors develop a strategy or a investment plan depending upon your needs and requirements. You just need to go to their website, tell them about your needs, how much is your risk appetite, how much do you return do you want, how much, and they will make a plan for you, particularly according to your needs and requirements. Also, peer-to-peer lending through apps and technological apps have been a recent phenomena in the industry. Also, new companies, startups generally needed funding. Nowadays, a lot of new apps are launched which lead to crowdfundings, where you can invest as low as 100 rupees to invest in a startup. It generally has an impacted on traditional financial services, and it also have a lot of regulatory challenges, but also have a lot of opportunities for the future. Cybersecurity in financial instrument. Cybersecurity, there are a lot of threats in financial markets, that is hacking, data breaches, fraud. A lot of protective measures has been taken by the in the financial markets, such as encryption of data, adding firewalls, and all-time monitoring to make sure that data breaches don't take place and to minimize fraud. Cybersecurity has a lot of importance in regulatory compliance, but cybersecurity is the utmost need at the moment, as a lot of traditional banking or investment things are going online. RegTech, regulatory technology. These are the technological solutions for regulatory compliance. In this, automated reporting, risk monitoring, as well as fraud detection can be used by the system itself without any human intervention. It leads to improving efficiency, has a big role in improving efficiency, and it also reduces cost and removes a lot of unnecessary intermediaries from the system. Impact of AI, ML, artificial intelligence, and machine learning. AI ML can be used in the financial markets for predictive analytics for market trends, what the future is gonna bring. They automate a risk assessment, and they can also AI ML can also be used for portfolio management. Machine learning enhances decision-making capabilities of the systems so that the loss making or the fraud can be detected early to minimize loss for the investors. What are the future trends in market operation? One of the most common is the integration of AI, blockchain, and big data analytics in market integration. Continuous evolution of regulatory frameworks need to be there in the market operations to minimize risk. Also, increasing digitization and automation needs to be there to efficiently manage market operations. Now comes the challenges in financial market technology. Systemic risk from technology failures are one of the biggest challenges in the market, financial market. Loss of data, ethical concerns in AI is also a major challenge that the financial institutions need to take care of, and the regulatory body should regulate or keep a supervision about that. Financial market technology should also balance innovation with security and transparency while improving the efficiency and the handling time of the trade or the securities. Now we would come to the conclusion for today's session. First, financial markets and institutions form the backbone of economic growth by efficiently allocating capital. A variety of financial instruments and institutions serve diverse investor and borrower needs. Regulation and oversight ensure market integrity, investor protection, as well as systemic stability of the financial market ecosystem. Technology plays a big role, and it is transforming market operations, enhancing speed, transparency, and accessibility for all sections of the society. Continuous innovation and regulations and evolving regulations are very vital to adapt to changing financial landscapes. What are the importance for stakeholders? For investors, understanding market dynamics aids better decision making and risk management. For institutions, compliance with regulations and adoption of technology improve trust and efficiency. For regulators, balancing innovation with safety maintains market confidence. For economy, robust financial markets support sustainable economic growth and development. Thank you.